assistance at any point throughout the meeting, please just let me know. That just about covers everything for me, so without any further delay, please let me hand you over to the founder and managing director, Abdulaziz.
Good evening, everyone. Thank you so much for coming here. It's always exciting to see you year after year. I tend to think of this more like a reunion as opposed to a shareholders meeting. And special thanks for some of you who have traveled from far to join us here today. And thank you, Roland, for helping organize the Khobar version of the meeting. As you all know, for the past several years, we've been doing two versions of the meeting, one in London, one in Khobar. And as we expand the geographic footprint of our investor base, we hope that, hopefully we won't need to do more geographies, but we hope that Khobar will be, at least I hope that Khobar will be the one that becomes akin to Omaha as time goes by. So, let's go. This is our agenda today. So I always like to talk about what I call the three pillars. And the three pillars are essentially what I think that everything that we do depends on, and the success that we generate has and will continue to depend on. And the three things that I think are most important to us, the first one is our partnership principles. And I always think of our partnership principle as a constitution that is more binding, unlike the UK's one, but one that is clear about the intentions and the way that we will deal with each other as partners. I always talk about the history of this being born out of the relationship with the first founding investors, where it was a small group of family and friends, and how I wanted to preserve that culture and the relationship as we grew in terms of the number and size of investors. And it's essentially four things. One is how we communicate with you. We'll never sugarcoat the truth. We'll tell you things as they are. We'll accept responsibility when we make mistakes, and we'll tell you why. The second one has to do with an alignment of interest. So we're all together, we're on the same terms. The third one has to do with our investment horizon. And people often talk about being long-term investors, but for us, being a long-term investors, I think, at least in the way they do it, precludes us from investing in the short term. So we are only focused in the long term. We believe that that focus gives us an edge in how we apply our strategy and process. And finally, our risk aversion, that we always think about risk before we think about return, with the goal of preserving capital long term, which we believe helps us succeed. People talk about football, American football metaphors, but we basically win by playing defense. The second thing, if we think of our constitution as the why of what we do, our investment philosophy is essentially the what of what we do. When we wake up every morning, what do we think about doing? And we're essentially looking for two things. We're looking to buy shares, in our case, equity securities in, equity securities in what we call great businesses that sit within great companies, and we don't want to overpay for them. So that's the value part of our philosophy. And the reason we do these things come from kind of an essential underlying philosophy that determines how we, well, you could argue our worldview as individuals and investors. We've been talking about them. I mean, Mark, our head of investor relations, has a more sophisticated name, sources of alpha, he calls it. But for me, the way I think about them is why I think we do better. And I think we do better because we do three things differently. The first one is something that we call our ethical owner approach. And essentially we're thinking as owners and partners with the management teams that run the companies that we invest in. Which means by being owners or being partners with those people, it determines a lot of things. One, I think it drives our long-term investment horizon because we think as owners, and so it means we have to think about business fundamentals over years and decades. The second thing that I think is fundamental that a lot of people, it's now sexy and exciting to talk about being responsible investors and PRI and ESG and things like that. But if we are ethical business owner, or if we come in with an ethical business owner mindset, I think it just is intrinsically consistent to have the values of the management teams and the businesses that we invest in being consistent with our own individual values. I don't think we think of ourselves as separate from those businesses and the actions of those businesses. I think morally we also have responsibilities for. So that's why since the beginning we always talked about being responsible investors. And people have always talked about, well, is this a form of Sharia compliance? And I've always seen it as one and the same because of at least in the beginning, because of my background and the background of our investors. The second thing is the idea of learning from behavioral science. And I think one of the things that I learned very early on is that despite what my mother has been telling me, I'm not that special. And so realizing that I'm not special or smarter than other people made me think very early on when I was started investing about how can I gain an edge on other people. And I believe, or at least at the time and continue to believe, that having using behavioral tools to become more rational than people. So I may not be smarter than everybody else, I may not be able to crunch numbers faster than everybody else, but if I can act more rationally, if my decision making as a team can be better than average, then I think that will lead to better than average results. And that's why a lot of what you do is informed and continues to be updated and improved based on learnings from behavioral science. We always talk about our process being checklist based and how we build kind of guardrails that help us deal with our own emotions and lead to more consistent and better decision making. And the third thing that also is part of this is, I think, is a probabilistic view of the world. So I think most people, and it's just naturally human to think about the world in more discrete and deterministic things. So we think, a normal way of describing this is to see the world in black and white. But I think it's not even enough to see the world in grayscale. You need to see it in its full colors when you look at decision and try to see not 1, 2, or 3 scenarios, but try to expand the spectrum of what could happen and think of things within a kind of a probability curve as opposed to a number of discrete outcomes. And I think that is very important in investing in general. But we also have the edge being investors in securities that we can also size positions based on the information that we get out of that versus someone who invests in, for example, PE or real estate, where you may not be able to size the position differently because you are dealing with assets that are more lump sum in nature. All right, update on our performance. So since inception, for Class A, initial series, net of all fees and expenses, we're up 115% against 89% for the MSCI World. This is what it looks like year by year. I want to highlight 2 things though here. The first thing I want to highlight is the edge that we have gained in every single year on a compounded basis is what looks like a relatively small edge. So net of expenses and fees, we're looking at about a 2.5 percentage point difference per annum between us and the benchmark. Yet when you compound that difference over long periods of time, you see that margin of outperformance expand. And this is one of the things that I came across when I was playing with these numbers 20 years ago when I started investing. It's the idea that you can have a small edge in any one year and then have the power of compounding work for you year after year after year and see that build up substantially. I think that was one of the things that I found really interesting and very exciting. And it's one of the reasons I got into this because it's very counterintuitive. People think that in order to build a big edge over time, you need to do great and amazing, but actually it's these small differences over time that accumulate that will produce the best results. And then the other thing that I want to point out here is if you look at the relative performance column in this table, is that you'll see that the bulk of at least about 2/3 of our outperformance, but also the best years of our performance were years when the markets were down. That's also the same when looking at monthly data. So 70% of months when the market was down, we outperformed, and you'll see that about 2/3 of our outperformance came in down years. And that has to do, I think, with value strategies in general, but it also has to do with our conservative approach, which is part of our fourth partnership principle, risk before return. And again, like I said, we always think about winning by not losing. And if you don't lose a lot of money in down periods, then you start from a higher level when you start to compound again once the markets recover. So look at the past a few months, contributors to performance. So the top 5 contributors to performance, we've got MasterCard, everybody knows that. Denelm is a fascinating retailer that sells Tupperware and curtains in the UK, cutting edge stuff. Evertech is a payment processor in Puerto Rico that we own a small position in. UPS is a position actually that we started earlier this year that's worked out very well for us. And Merlin, which we talked about before, is the holding company that owns Legoland, that recently got acquired by Blackstone from us, unfortunately, because it was a holding that we would have liked to own for a long time. And you see that the contributors to return here are fairly distributed between those top 5. It's a different picture when you look at the tractors, where we've got 2 positions that really over the past 12 months have been a real drag. The biggest one is Nordstrom, and Aubrey is going to talk about it a little bit later. And Henkel has also been the tractor for about a couple of years now, actually. And then the other ones were Essential, Brenntag, and IBM. IBM we exited, and Essential actually we exited this month. But there are small drags over the past 12 months. This is a look at our portfolio as it sits at the end of August. The largest position now is United Parcel Service, UPS. Alphabet, which we've owned since inception. Henkel, again, we've owned pretty much since inception. Samsung Electronics, which we've added to earlier in the year. It's a couple of year old position. LabCorp, which does blood testing. It's the second largest and, in our opinion, the best run of the 2 largest labs in the US. Richemont, which owns Cartier and Van Cleef. Please do your best. Hong Kong is a big market for Richemont, and it's been struggling, so we need your help in kind of helping there as much as you can. Essential, the largest business is WGSN. We talked about it last year in the meeting, and we've exited it actually this month. Discovery, which owns Discovery Channel, Science, the Food Network, and HGTV, among others. Unilever, also a very long holding that we've had for a while. And Brenntag, which is a chemical distributor, which we started buying early last year. And this is the geographic distribution of our portfolio as it is today. About half is in North America. About this time last year, we actually were in the low 40s in North America. The biggest add here was adding UPS to the portfolio, and then we've added a few top-ups to existing holdings. Europe has actually come up a little bit now, but we've exited a few things in the UK over the past 12 months, so that's brought Europe down a lot. And actually cash as of today is up to about 21% because of the Essential exit, minus a purchase that we are doing right now as we speak, that we'll write about in the next quarterly letter. Looking at sector again, broadly diversified here, very similar to the way it was last year, no major changes. Perhaps capital goods is the one where it's expanded a lot because of Vestas, which is in the top I think it's just right under Brenntag now, so it's, but it's in the top 10 right now. All right. Aubrey unfortunately couldn't be here, so we'll have to show you the video presentation instead of a live link. I think next year to account for the technological challenges of this, we'll just bring Aubrey and probably a couple of others from the team down to Khobar for the meeting, inshallah. So I'll run Aubrey, who he'll go through some of our portfolio holdings, and then it'll come back, and we can have just a general Q&A, but obviously specifically some of the stuff that Aubrey will be talking about.
Right, now to show you why analysts should be stuck behind a spreadsheet and not in front of PowerPoint. Okay, Vestas. Okay, they build these massive onshore wind turbines. Actually, slightly bigger than that one. That is a 60-centimeter Lego model. The real things are more like 160 meters, so a little bit shorter than a gherkin and a bit taller than a walkie-talkie, the buildings, that is. I mean, they really are massive. I mean, the blades are like 50 meters each, so that means the diameter is something like the size of a football pitch. Now, try and imagine actually transporting one of them. So it can actually take Vestas something like a year just to organize the logistics of getting a blade from factory to the farm. And we think that's a great thing because you take solar. Solar can be shipped from China to England, actually, or Hawaii, where solar works a little bit better, really easily, whereas you can't ship these things so simply. So you're not going to get Goldwind, the number 2, flooding the market with cheap turbines. Now, Vestas, they are the number 1. They have a 22% market share. And if you look at the number 2 and 3, Goldwind number 2, they're predominantly China, General Electric, predominantly US, whereas Vestas are global. The thing we love about this business, or I love it at any rate, is the service business. Now, it's only about 16% of revenues, but they sign 5 to 30-year contracts. And these are 20 to 30% margin contracts. So these are, I mean, enterprise software does not have 30-year contracts. Pity we don't get the multiple that they do, though. But hey, but then the other thing about the service business is that it takes something like 4 years in order to actually receive the first revenue check. From the point you sign your contract, you've got the time it takes to ship it, the time to do all the building, and then you get the free warranty period. So the first year or two of your wind turbine, you'll have free servicing. So what that means is there's a lot of hidden profitability within Vestas. In the 10 years to 2016, they installed 54 gigawatts. And in the following 3 years, they installed 33. So we can see all that service contracts that are coming through within the next 3 to 4 years, and coming through at 20 to 30% margins. So for us, that's pretty good. Now, what has happened with Vestas? Okay, pricing. I'm afraid to say it has been pretty dire, but it's stabilized. And we could see that it was stabilizing when we looked at the order book. But you see, the thing about pricing is that it's not about revenue. The old adage, revenue is vanity, profit is sanity. The reason prices keep falling is because the costs keep falling. For instance, the new Inventus turbine, which they have just launched, is 30% more efficient. So, they can charge 25% less and still pocket a lot more margin for themselves. But because the costs and the prices do not match, especially with auctions, you do get short-term margin volatility in this business. But, we don't mind that because whilst prices are declining, the levelized cost of energy has also been declining, as you'd expect. And wind is now the cheapest form of energy. It is cheaper than gas. It is way cheaper than coal. And we believe in 2021 it will be cheaper than existing gas. So at the moment it's cheaper than, to build a wind farm is cheaper than to build a gas turbine. But it's not cheaper than an existing turbine, because an existing gas station. But in 2021 it should be, with the new developments that we're saying about inventors and such. And so we don't require green subsidies. We don't require people to want to use wind because they're being green. We just want the economics to play out. And the LCOE does actually include when the wind is not blowing or when the sun is not shining. So this isn't all, as I say, the economics will out. And that's what we're seeing. In the last year, the order book has increased by 38%. Compare that to the 14% CAGR that we've had previously. We believe a lot of that is due to these falling prices. So yes, we're pretty happy with that. And right. Merlin, okay. They are the second largest theme park operator, second only to Disney. But they're a lot more affordable. Recently took my daughter to Disney, and I'm still. I'm a value investor. God, that hurts. Merlin, on the other hand, they have a wonderful, diverse range of attractions, from Legoland, which is their crown jewel, to the London Dungeons, to Madame Tussauds, Sea Life, and these are much more affordable attractions. And I'd say that this is not consumer discretionary. This is a consumer staple. I have a daughter. There is no way I can avoid Legoland at least once a year, or one other of these attractions. Summer holidays are just too long. So they have this diverse portfolio, and it performs well. And because of the diversification they have between indoor, outdoor, geography, across the capex cycle, they don't all do well at the same time. One does badly, but you can take capital from one, reinvest in the other, and it makes a cyclical business relatively stable. Now, what's happened? This has been a roller coaster of an investment. I'm sorry. About 6 months ago, Value Act come in, and they go, share price is too cheap. Well, we think management should take it private. Okay. Several months later, management agree. And they come up with this lowball bid from Kirkby, who are the Lego family and the 29% shareholder, Blackstone, and CPP. Now look, I can't blame CPP for being a good value investor. Yes, we think it's a lowball bid, and that in itself, the thing that does stick in the throat a little bit is the question of independence. So obviously Kirkby, being the major shareholder and owner of Lego, have good insight into the business that the rest of the city does not. The fact that the chairman was there when Blackstone last owned it. The senior non-independent director was actually appointed by Blackstone, and this is the guy that recommends to shareholders that we should accept this lowball offer. Anyhow, sorry, I could rant about that, but yes, we've done well out of it, but I now have to go and do some more work and find some other great businesses. Right, Dunelm. Okay, so we're in the middle of a retail apocalypse, so why do we own retail? And the thing is, we are still seeking quality. We haven't lowered our quality bar. And it is harder to find quality in retail these days, but there are still pockets, places where you can find some niche business that still has the quality that meets our threshold and, also got sold off. So Dunelm are the leading UK homeware store. They have about a 6 to 8% market share, and that means it's a pretty fragmented market. And that's great because they have a massive cost advantage as a result. So many mum and pop shops, smaller stores, that just cannot compete with the scale leader. Now, they have a specific focus on things like blinds and curtains, and these they will do to custom sizes, which in the UK with non-standard windows and ceilings is actually really quite a big differentiator. And now, yes, you can find stores online, but it's going to be quite a premium. Then the other thing they sell are things like Tupperware, kitchen essentials, utensils, and other such essential things that I didn't realize were so essential until I took my wife on a research trip to Dunelm. And that was actually quite expensive. I didn't know how many, well, yes. But what I found so extraordinary was that they are able to undercut Amazon on so many things. I bought a suitcase, which was like 20 quid cheaper than I could have got it on Amazon. The Tupperware my wife bought was, again, like 20% cheaper. And of course, that's because they operate out of these big box retail, where rent is something like £5–10 a square foot. And when you're shipping something that's fairly low value but fairly bulky, you just can't do that economically. So they are able to outperform. And then one of the other things we like about it is that they have a very long maturation period. So there's a C-level exec at one of the leading retailers, UK retailers, and he was telling me that their homeware section can take something like 3 to 4 years to reach maturity. And that he often sees competing stores, homeware stores, nearby him just flounder and fail because they can't withstand that level of pain. So that's one thing that sort of moat that we really like with Dunelm, but also it means that all the new build stores they have are under-earning. So again, you have this element of hidden profitability that if you can extend your time horizon to see these stores mature, you actually see the profitability increase without having to do a huge amount of work. Now, what's happened with Dunelm? Okay, so 2017 was a bit of a nightmare. Obviously, a lot of Brexit turmoil. Housing transactions had just fallen off a cliff. But you see, people will still replace blinds and whatever, but moving house is that catalyst. So you just delay it a little bit, which is sort of what we saw in 2017. But we've seen growth pick up quite significantly. Same-store sales have been excellent. This has been helped also by a mean reversion of mortgage approvals. And actually last month, July, was the highest UK's had in 10 years. But the thing we really like is that they've been taking share. In this chart, you can see their growth compared to the market. And again, that just is testament to the fact they have this massive cost structural advantage, where they're able to sell better quality for less cost, which is something we like. So, business we think is still positioned well. They've grown online sales in the mid-30s, which is now 16% sales, and we're certainly happy with the business. Right, final company I want to talk to you about, Nordstrom. Yeah, that's been painful. Now, admittedly, one of the reasons is that it was about a year ago that management wanted to take the company private, but that bid was rejected. And as you can imagine, the share price has reacted. But there has been weakness as well, which I'll get to in a second. So Nordstrom, they sell apparel, women's apparel, shoes, men's apparel. You can see the breakdown of sales there. But these are much more upmarket than the competition. And you look at their demographics, and they have the youngest demographics of all their competitors, and they have the highest income. But also what we like is they have invested much more into their stores and into online. I mean, online is now 30% of sales, or a little bit more. Right. But what we have seen is recent weakness in same-store sales. And where is this weakness coming from? Well, part of it, yes, Amazon, online, but again, they have a big online presence, so they're doing well out of that. Discounting, has hurt, but they have, really good discounting off-price range. But then, one of the other things we've seen is that In 1975, the personal savings rate was 12.5% of personal income. People were saving 12.5%. And that declined to 2.5% in 2005. But since then, it's gone from 2.5 to 7.5, 8%. And you just look at that and think that has to be a headwind. And it's not just that headwind of people saving more. It's also the mentality behind that. People are becoming more frugal. But this is a trend that cannot go on forever. You cannot keep saving more and more of your income. As much as I'd like to, I cannot save 100% of my income. My wife won't let me. So the question for us really is, how are they positioned? When we do see mean reversion, or even if not mean reversion, even if these headwinds just abate, how are they positioned for this? And the answer is actually really well. See, in this chart here, see the red is their capex minus depreciation divided by sales. And compare that to the competition. So basically, Nordstrom have been over-investing. They have been investing for growth, whereas the competition have been consistently under-investing since 2009. They've been squeezing their businesses for cash. And that's why I've got the rather cheeky picture of the tired-looking Macy's there. Because this is how you become a category killer. By investing when everyone else is squeezing their business for cash, when everyone else is really tightening their belt, and you're able to invest, that is where you can position yourself to be a category killer. And what we are seeing is that capacity is now being taken out of the industry. We're seeing other people shut down stores like that, which means that when we do have that mean reversion, Nordstrom are positioned to be a winner. And again, this is just another example of extending your time horizon by looking past the short-term volatility of of seasonal and quarterly sales numbers, and looked just a few years out. That is where the opportunity lies. Thank you.
Thank you, Aziz, and thanks to Aubrey for the quick update. Now moving to the Q&A session.
You didn't clap for Aubrey.
Now moving to the Q&A session. During the session, we will alternate between questions sent across by email in advance and questions from the floor, and we'll finish at Kings.
Unfortunately, in London, I send the difficult questions to Aubrey. Unfortunately, here I have to answer them myself. I didn't plan properly for that one. I don't think your microphone is on. Okay. Yeah.
Yeah, thank you, Aziz. So in light of the recent interest rate cuts and in anticipation of the future cuts, so we understand that these are early signs of an upcoming recession. So in your opinion, what would trigger the upcoming recession? Would it be the China-US trade war?
I don't know. I mean, that's the truth is I don't know, and I could spend the next 10 minutes pretending to say things that lead to the same conclusion. I don't think anybody knows. The nature of these things is that they are not predictable, which is why I think it's always, if you can, which by the nature of the way we're structured, I believe we are. But if you can structure yourself, especially in the type of an investment horizon the underlying investors, not just the team, think about, if you can think longer term than a year or two, which I think we do, then yes, we don't know, but I don't think it matters. When we're looking out at anything that we do, we're valuing things on a 5 to 10 year horizon. And we know that at some point during our valuation period and during the period that we own something, there's going to be a recession, maybe even two. And we need to think about two things. One is we need to buy businesses that are resilient, that we know will survive recessions, which is why we don't like companies with a lot of leverage. And then the other thing that you need to do specifically when you're looking at things that are cyclical in nature, you want to make sure, A, when you value those businesses and when you need to look at through cycle margins as opposed to yesterday's or last year's margins. So when you do your evaluation of a cyclical name, you need to basically account for that. And then you also, I think, need to make sure when you do your evaluation of a cyclical name, you often need to be a little bit more careful about, at the very least, know if you are at the top half of a cycle or the bottom half of a cycle. It doesn't necessarily mean the general economic cycle. Often businesses and industries have their own. But other than that, I don't think it matters. To me, if the business is going to survive for the next 5 to 10 years, then all you have to figure out is basically value it with the knowledge that there's going to be a recession at some point.
Thank you, Abdulaziz. I have an interesting question here. What sanity checks do you conduct to check your assumptions?
Well, I guess it ties to that question to some degree, but I mean, there are many things that we do that require assumptions. Valuation is often an exercise. I mean, I think Warren Buffett once said, if all you need to do to be a successful investor is understand history, librarians would be the richest people on earth. And they're not. So there's a lot more to investing than just looking at the past. An assumption, anything about the future is by definition an assumption. So we do a lot of things essentially when we build a financial model of a company where we're trying to predict what the business is going to do over the next 5 to 10 years, there are several areas where assumptions exist. One, basically, when you have any model, junk in, junk out. So when you look at margins or revenue growth assumptions or asset turns or any of these things, you need to be careful about your assumptions. And the thing that we check against is when we run a simulation, we want to see that our assumptions, A, fall within historical norms. So at the very least, we cannot assume something about the future that is completely inconsistent with the way the business has behaved in the past. Sometimes we have to, and when we do, that requires a lot more work. But we have to be cognizant of the fact that we're assuming that something fundamental is changing. Often we are actually assuming things are going to be worse than the past because like a business is maturing or an industry is changing. And sometimes, at least relative to the short-term past, we could assume things are improving. But we always measure against the past, or compare to the past, and kind of have red lights flashing if we assume something that's inconsistent with the past or with the industry. So that's on the assumptions, on the fundamentals. And on the valuation, we also compare the valuation model that we have with the way the shares have traded in the past. And we know that the market can be wrong, but the market is not going to be wrong about a company for the past 10, 15, 20 years. And so if we have a model of what something should be worth, I mean, if I'm oversimplifying here, but basically, let's say we look at a business and after doing our work, we think intrinsically it's worth 15 times earnings. If we look at the past and it's always traded between 12 and 14 and never went above 14, or very rarely went above 14, there's clearly something wrong about our model. So we always, on the valuation side, where there are embedded assumptions about valuation, compare to the past of where something has traded, kind of as guardrails, to protect us against being too optimistic or too pessimistic about valuation. And then I think that the other thing where we also have kind of sanity check against valuation, and some value investors think this is what I'm going to describe as a bit blasphemous or dirty. But we also compare the next 3 years against estimates. And again, for the same reason, if I find that our estimate for margins or revenue growth 2 years out is completely out of whack with what 15 or 20 analysts on the street think. I have to have a very strong reason to say that. At the very least, I need to stop and think about the embedded assumptions. So those three, I think, kind of help guide us to make sure we're not making assumptions on a systemic basis.
Any questions from the floor?
Hi. So just I'm a newcomer, so just wanted to know what's the filtering process or what's the investment process. So you have thousands of companies in the world. How do you get down to the number that you have? So how do you get companies? How do you see them?
Sure. So essentially, there are two ways where something can essentially come three ways, let's say, at the first level for an idea to be of interest. The first one is we always run quantitative screens on our global universe. And here we're basically searching for companies that have or exhibit characteristics, financial characteristics that we find attractive. We're not screening for valuation at this stage. So we're looking at companies that have higher returns on capital, higher returns on equity, that are consistent as well across time, low volatility of revenue, stable margins over time, and high free cash flow conversion ratios, for example. I mean, we run a few of those, and each one is trying to be different. The risk with quantitative screens is if you slice them and dice them too evenly, you don't end up with a lot of ideas, and if you overdo it, you end up with too many. So we try to run a few and see where they intersect and come up with. And we get ideas from that every now and then, and most of the stuff that quantitative screens kind of spit out are junk. There's something there that looks good, but actually, if you spend 5 minutes on it, you realize that, well, the market is not stupid and there's something very obviously wrong about it. Or it's very clearly outside the parameters of what we're looking for. So that's the kind of one way of idea generation. The second source of idea generation is there are many people who this quote is attributed to, but what is it? Good artist copy, great artist steal. So we steal ideas from investors that we follow all the time. For regulatory reasons, a lot of investors file something, at least especially the ones that invest in the US, called the 13F, that they file with the SEC on a regular basis. And we have a list of investors, and we have alerts on their portfolios. And when they buy something, it flashes in our screens, and we look at it. And if you follow 100 or so great investors that are doing something similar to what you do, sometimes they'll come across something, and we won't just buy it. This is just a source of idea generation. So at the very least, this is something worth considering. And I have no shame in copying someone into an idea if it makes sense. I mean, and the third source, which often has a low kind of throughput, so not a lot of ideas come out of the third source, but actually the hit rate on this source is very high, well, you can think of it as serendipity, which is a combination of luck and being at the right place at the right time. And this will include a few things. So this will include, I attend a lot of these idea dinners, where we have dinner somewhere, and everybody, or a couple of people pitch an investment idea. And sometimes you find good ideas there. I go to at least 15 or 20 of them a year. I can get one idea, which is a decent hit rate out of that. At least something worth looking into. So that's, again, by being there at the right place at the right time. But, I mean, we talked earlier about Essential, which we sold earlier this month. But the biggest business inside Essential, Essential used to be called, I think it was eMouth. When it was a traditional publisher, got acquired by private equity, and then relisted in 2015 or 16 when we started buying it. But one of the division that they ended up buying while they were in PE is a fabulous business. It's I still love that business. It's called WGSN. And WGSN, we talked about, I think, at last year's meeting. It's people sometimes kind of compare it. They say this is the Bloomberg of the design, fashion, and media industry. But what it is essentially, it's similar to what a Bloomberg terminal has, at least in terms of the economics, where you pay a subscription, and it gives you access to and then this used to be a paper-based catalog, I think 20 years ago. But they'll tell you what next year. By the way, those guys decide what we all wear and what colors you'll see at Starbucks. And but they'll predict what next year's essentially hot color is going to be, what cuts of dresses are going to be popular, where they're going to be sold, and then in real time tell you what is being sold, in what color, in what sizes, by whom, and at what price. And so if you are a retailer, if you're a designer, you need to have that data. And if you are doing anything that touches design or culture in any way, you have to have access. So you've got Starbucks and Chanel and everybody in between, including people who design fabrics and curtains and furniture as subscribers. And each one of them pays, I think last year it's $25,000 a year per user to subscribe, and the renewal rate is in the upper 90s%. So wonderful, wonderful business. Very difficult to come and compete in the same way Bloomberg and Reuters dominate financial data. The first time I came across this business is listening to a podcast called 99% Invisible, which is a wonderful podcast on design and architecture. So it has absolutely nothing to do with investing, but I believe that I need to spend a sizable chunk of my time doing things that are not in finance or business, listening to things and reading things that are in finance and business, because this is where serendipity comes into play in terms of idea generation, but also I believe it gives us as investors a different perspective when we look at these things and how we analyze them. So yeah, I mean that's the three are the main sources. And filtering things out, I mean, in our process we talk about something, the first phase of our process we call killing the idea quickly. And there are two reasons why this is the first phase. The first reason why the first phase of our investment process is killing the idea quickly is essentially laziness. For the first 12 or 13 years of my career, I worked by myself. I had a huge universe. I needed to say no quickly. I don't have all day. Well, I have all day. I've got 24 hours a day and I need to sleep and eat. So I needed to find a way to filter ideas quickly. So I developed a methodology, and Aubrey, when he came, we together improved it, especially by making it quantitative and more automated. But basically, it's a set of essentially quantitative and qualitative screens that we can run. The quantitative we can run in 5 minutes or less. They just tell us there are a lot of things that seem wrong with the financials, or either because there's evidence of accounting manipulation or a deterioration in the business. And essentially, if we see enough of those in a business, it's a reason to say no. They always say there's never one cockroach in the kitchen. So if you see a cockroach, it's probably another one. And so we do these very early on. It gives us the ability within 5 minutes to kind of screen out a lot of potential investments.
If you were to pick one of the companies that's dragging your performance, and you actually can be in the shoes of the CEO, what would you do to unlock shareholder value?
It's a very good question and a hard one. I guess given that pretty much all of the drag the past 12 months has come from Nordstrom, it's only fair to address that one. I could pick another one and take the easy way out. But let's talk about Nordstrom because it matters a lot. It's a big position, and obviously it's dragged our performance by a fairly substantial amount. I don't know that I would be able to do a better job than what the current management team is doing, to be honest. I think what's happening, Well, there are two things. Let me dial back. There are things that I think are hurting the shares in the short term, and there are things that matter for the long term. So in the short term, there are three things that have happened to Nordstrom the past 12 months that have hurt the performance of the company. At least the performance of the shares. The business is doing okay. The first thing I think is that there was a failed bid by the family 2 years ago to acquire the company. They bid, I think it was $50 a share. The independent board members rejected the offer as being too low. The shares are now in the higher 30s, so maybe we should have taken the offer. But at the time, and we believe the same, knowing what we knew then, we believe the shares were worth a lot more, and we thought that the family, which owned a third, were underbidding. So that's one reason I think that so a lot of people who got in sold the shares after that bid failed. That's one thing. The other thing is, which is probably the biggest component, is in general, retail, specifically the department stores in the United States, but retail in general, has had a very bad year. I mean, if you look at Nordstrom, Macy's, JCPenney, Kohl's, pretty much the whole industry has gone, the shares have gone down a lot. And actually, on the stock part, Nordstrom has done a little bit better than the best of them, a lot better than JCPenney, which was the worst performer. But on the fundamental level, if you look at revenues, margins, and so forth, they're way, way better than the others. So fundamentally, if there was no stock market, and I can only look at the performance of the business relative to the industry, they're doing very well. The third thing I think that's been going on this year is there have been a few execution mistakes at several points in the market. So for example, the most recent quarter, which has hurt the stock, they have a big event, which is their anniversary sale. And they entered the quarter kind of inventory light. And sales actually, or demand actually, was much better than expected. And they sold out a lot of things very early in the quarter. And that hurt the anniversary sale specifically, which is a big event, so that was material. And specifically, and then the other thing is on the discount side of Nordstrom, which is the Nordstrom Rack business. I think there were some pretty big execution issues with what they had on sale. So that you can argue is just the nature of the business. You're going to have some good quarters and bad quarters, good years and bad years. It probably did not help that the CEO, so Bruce Nordstrom, who was, this company has 3 co-presidents, all from the Nordstrom family, but Bruce was the more senior of them, and they kind of was initially just, he was the only president, and he elevated the two. Also, first was dealing with a cancer diagnosis, and then he also passed away unexpectedly. And so that, to some degree, probably also hurt his performance early in the year before that happened, and probably the performance of his brother and cousin as they dealt with the situation. And you see over the past few weeks, they've reshuffled the management team and added more people to it to have a deeper bench. So I think it's a confluence of a lot of issues. The issue of savings that Aubrey has talked about in his side of the presentation. There was an article actually yesterday in the Wall Street Journal where they analyzed this. And this is the first time in I think it was 40 or 50 years, the period where they have data, that every single economic cycle, savings start high at the beginning of the cycle and they go low as the cycle matured. This cycle, the opposite has actually happened. So people started with a low saving rate, but especially over the past 3 or 4 years, the savings rate has increased substantially. And then there's also a bigger jump with the Trump tax cuts from 2017. So actually, and the bulk of the increase in the savings rate has been in the higher part of income, which is also what the typical Nordstrom customer is. So we also have kind of that, at least headwind of an increased savings rate over the past few years. So it's a lot of things, no one thing that's particularly bad, it's a lot of small things that are kind of not working. I mean, to put things in perspective, they still have an all-time high revenue. Last year was, I think, the all-time high profit. Margins have stabilized and are moving upward. Same-store sales in online are booming. A third of the business is now online, and then they lead in that business in the US by a huge margin. Their customer satisfaction rates are very high. And then on the online business, they're executing, and in terms of profitability, it's going very well. So the situation is nowhere near dire, but it's been definitely a disappointment the past few months, and you can see what has happened to the stock. And we'll see. I mean, we're going to look back in a few years and see if we were right or wrong about this one. We continue to hold it because we still think, at least the long-term issue is still intact, but you can ask me about it in 3 or 4 years, and if I believe we screwed up, I'll say we screwed up.
I have a couple of questions. One is, how do you, I see that your holdings are about 20% in Europe. Sorry. I see that your holdings are about 20% in Europe. And I'm wondering, how do you counter the currency exchange issue, especially that it is volatile in the recent years? I know that you're usually thinking 5 to 10 years terms, but still the changes has been drastic. And the other thing is, coming back to the question of the recession, expected recession. There are two views, I think, in this, and you're the expert, so you...
No, trust me.
One view is Talal Abu Ghazala's video, where there's an Armageddon coming, and everything is going to crash, and everything is going to, the end of the world. And there's the view where you have a couple or 3, most probably, recessions, and not depressions, that are going to come on a gradual basis. I see in the US, for example, the Federal Reserve is still keeping what you call ammunition, but their rate is also expected to go down, meaning they are subsidizing against that. So what's your view? Where does your view fall? Is it an Armageddon, or a couple of recessions, or nothing at all?
Sure. So on the geographic exposure, this actually, I'm just looking at this, and I think this is, I'm trying to do the math correctly. I think this doesn't include UK. Once you add UK, and you add some of the things we did in September, we're actually approaching 40% in Europe now. A little bit less. North America has come a little bit. Well, we'll see where we end the month. But our view on currency exposure is the following. And if you look at the quarterly letter that we send out, you'll see that in the geographic allocation, we'll report the geographic exposure of the underlying revenues of the businesses that we own. So essentially, if we think about ourselves as one big company that we own these businesses, and the revenue, so let's say, for example, here's our top 10. So we take UPS, and 6% of our portfolios in UPS, and I don't remember the exact distribution, but let's say 70% of UPS's revenue comes from the US. And it's a 6% weight. We'll take that 70%, multiply it by the 6% weight, and we keep doing that and adding each one of these companies where their revenues are come from, and then we add it all up and see where our portfolio revenues are coming from. Because the shares will be listed somewhere, but the revenue exposure may not be in the same place. And over a 5-year investment horizon, it's the revenue exposure that matters, not because eventually if we buy something, let's take Unilever. So Unilever, we actually own the UK listed PLC. So Unilever has a dual listing in the UK and in the Netherlands. So we own the UK one. But actually, low single digit percentage of Unilever's revenues come from the UK. The majority of the revenue comes from the rest of the world. About half actually comes from emerging markets. That is what's going to determine our actual risk exposure to currency over time. So that's what we look at. We want to look at the underlying revenues and then decide what our exposure is, not by listing, but by source of revenues. Once we do that, we are solving for two things. One is we actually want to be broadly diversified globally across revenue sources. And the reason is, if we went and we said we're going to hedge the euro, we're basically making an assumption that over the long term, we think that the US dollar is going to do better than the euro. And we don't know that. Maybe the euro does better. We don't know that either. So our philosophy is basically, as long as we own both, and we own both in a reasonable, we're not concentrated in any one place, then over time, if this does better, this will go up, and if this does better, the other will go up, and we'll benefit from the diversification by having exposure to multiple currencies. That is subject to one constraint, which is a risk constraint that is specific to smaller geographies. So for example, I think it was in the contributors, you see I mentioned Evertech. That's the third largest contributor to performance. So Evertech has been a very good performer for us this year and last year. And at times it was ridiculously cheap in our opinion. However, Evertech gets about 70% of its revenue from Puerto Rico, and the rest from a small handful of Central American countries plus Colombia. And we just did not believe that that kind of concentration in terms of geography is a risk that we are willing to accept to make it a full position, like a 5% position. So even though we really liked it and liked the risk-return profile of the investment, we kept it small deliberately because we wanted to constrain the risk exposure to that geography. Now to your second question on the issue of whether it's Armageddon or not. So John Authors, who used to write for the FT and now moved to Bloomberg, wrote a really interesting opinion piece on this. And what the title was, "It's Not the Beatles." And what he says is that when he was growing up, every time he'd find a new band, he'd talk to his father and he said, "Listen to this band, it's really nice, listen to the music, the guitarist is so good." And every time he'd say that, the father would say, "It's not the Beatles." And the idea is, not every recession has to be a depression or a great financial crisis. The nature of things is that we as human beings think that the next time is going to be identical to the last time. And if I were to make a bet, and I won't, but if I were, I will bet that it's going to look nothing like the last time. And so every time someone comes and says, well, you know what? Lehman failed last time, and it's going to be another investment bank that takes us down this time. It probably won't be. And actually, it'll probably be something that none of us are talking about today. The nature of these things, specifically if it is something severe, it'll be something that we haven't talked about. And I don't think that is an issue now. But I do think, with certainty, that there's going to be a recession, and there's going to be a downturn, and life will go on. I don't think life will stop, and I don't think it's going to be the end of the world, and I don't think it's going to be Armageddon. And actually, if it's literally Armageddon, does it really matter? If it's Yom Al-Qiyamah, who cares? But joking aside, those things like the Great Financial Crisis, even when you look at them across geography, They don't happen that often. They happen from time to time, and they usually happen far apart in time that people involved forget. And I think it's an accumulation of kind of greed and laziness. And you have one generation that forgets the lessons of the last one. And I don't think that's actually present across the economy today. Even with everything that, I can give you a long list of things that I think where there's complacency. And it's not across the board, and it's not, the fact that everybody's talking about a recession consistently for the past 5 years tells you there's not as much complacency as before. There are always things to worry about, no doubt, but I don't think it's going to be the same. When you look at the question of, well, what the Federal Reserve is doing, I mean, the US has been doing very well for a very long time. It's actually the only place that's been doing very well for a very long time. You look at the rest of the world, they still haven't recovered. I mean, Europe is both economically and as markets below 2007. Well, Asia, anything that's connected in China has done well. Australia has. Other than that, the world has been stuck for the past 10 years. And if you look at the numbers in many countries, you see that more severely in Europe. They have been stuck and they continue to be stuck. And so there was no bull for it to turn into a bear anyway. But the US has done well, but I don't think there are big swaths of areas that I can look at and say this is going to be really bad when it blows up. Other than on the investment side. So I see some of that in VC, see some of that in PE, see in that some of the listed parts of the market, but I don't see that in economic fundamentals in the same way there was subprime craziness, for example, a few years ago. I think the Federal Reserve is doing what it's doing purely because of the what's happening with trade. I don't think they would be reducing rates if we weren't having this US, Trump decided that it's not a war, it's a spat. I think yesterday's what he said, the day before yesterday. And I think that's why they're kind of building in insurance because of that. But I don't think there's something fundamentally bad on the US side of the economy yet. But at some point there will be. That's a long way of saying I don't know, right?
Is the reason why we're holding 21% of the cash? Is this the highest it has ever been?
It was 21% cash exactly 1 year ago when we had the meeting here. And then it was remained high, and then in Q4, specifically in December, we went to zero by the end of December. So we entered January, we were at 0% cash. I don't think we never deliberately kind of a top-down decide what our cash position should be. But you can think of our cash position as kind of the output of our process. And where there are a lot of ideas coming through, a lot of attractive ideas, we'll buy them, and so cash comes down. And then when a lot of the things that we own hit our sell prices and we sell them, cash will go up. And so it's the interaction between the two, whether there are more ideas that we like than dislike, that determine our cash position. So one way to read it is that, yes, there are more things that we find expensive than things that we find cheap today. But it's not from the top down, it's kind of the outcome of it. But we also know that that can change very quickly. In the last week of December last year, because we also sold some things to buy other things, I believe we turned over 20% of our portfolio. So we went to zero and then some within 5 days. And in most of our history, cash goes up slowly and goes down very quickly. So we hope that we have two ideas, that one we're actively buying and one that we're working on. And if those come through, our cash may come down to 10% very quickly. But then if the market goes up a lot, we'll sell something. So we'll see the interaction of those two forces will decide. But definitely the market is not as attractive as it was in 2011, for example. Actually, or in December of last year, where from then till now it's up 20-something%. But in Europe specifically, there are still some pockets where we find some value.
So seeing the top 10 companies that you're investing in, I can see diversity of it. You can see technology, electronics, actually you can see electronics and health and consumer. But I didn't see much of online technology mix. Are you afraid of the changing of markets for that? And if so, I think like going through the whole cycle 2 years back, seeing how the online companies in terms of Uber, Amazon, and going on, they do have fluctuation in terms of investment, but they're actually very much profitable. This is my first question. Second question, it's a general question actually. What do you think about WeWork in terms of investment? I know it's still, they have some difficulties, I know. But as something new, fresh, do you think is a good way to go through?
So let's take the first one. I mean, Alphabet owns Google, so there is a little bit of online there. Our motto has always been, and I think will continue to be, boring is beautiful. We have these stickers on our computers at the office that read #NoFOMO, which is no fear of missing out. We have no problem missing out on things. We believe there are a lot of things that will make a lot of people a lot of money, and we're happy for them to partake in them and allow for them. That's not the game that we like to play. We invest in businesses that we think are, to us at least, understandable and predictable for the next 5 to 10 years. In a lot of these cases, we don't know what they're worth. I mean, you mentioned Uber, for example. I have no idea how much it's worth. I'll tell you, I don't think anyone, my opinion is, I don't think anyone knows what it's worth. It's probably worth more than zero, but I don't know what the midpoint of its valuation is. And so for that reason, I'm out, as the show goes. I think a lot of people make a lot of mistakes because they try to invest in everything, and a lot of what we do one of the most important things that we do is saying no. It's looking at something and saying, I have no idea what I'm doing here, move on. And I think it's probably the hardest thing, because everybody sees something interesting, and they always say one of the hardest things in life is seeing your neighbor get rich quicker than you are. It's very hard. That's why we have, I think, financial bubbles. You see your friends and they're buying new cars, and suddenly they're making money hand over fist, and they're generating 20-30% a month, and you're sitting there targeting 10% a year. It's not a pleasant experience to go through. Luckily, either because, I don't know, maybe my mom dropped me on my head when I was younger, it doesn't move me. In the hare and the tortoise, حفاو الأرنب, I'm happy to be the tortoise. On the second one, on WeWork, well, I mean, we kind of have an idea of what different people think. SoftBank seems, well, at least WeWork in their last round, seem to think it's worth 47 billion. And then when they actually went to the market, because of the fundamentals in the business and the governance issues, the market eventually said, maybe 10 billion, which is a lot less than the cash that went into the business. And I think that tells you something. I think there's a non-zero probability that it's worth zero, at least as the business model is today. Most likely, it's worth something, and that something is a lot less than what people are talking about. I mean, we have businesses that are kind of similar that are listed. So Regis is listed under a company called IWG, and they are A, bigger than WeWork, and 2, profitable, and 3, have a history of both being profitable. And I haven't checked in a while, but I think the market cap is 4 or 5 billion pounds for Regis. And sure, WeWork is fun and awesome, and it's an amazing atmosphere, and the interiors are funkier, and they have free beer and coffee. But is it really worth 10 times, especially when it's losing money? I don't think so. Time will tell what it's worth, but I suspect that it's worth a lot less than 47, perhaps less than even the 10 billion that people today have been offering them.
Any more questions?
Okay,
Here.
sorry. تعليق على I would discount of the WeWork thing. I agree with you. But don't you value brand at all? I mean, brand must have some value. Not WeWork, but in general. Do you actually consider brand value?
Yeah, I mean, I think brand is very important as a competitive advantage. And when you look at Richemont, for example, that's the main competitive advantage, that you have Cartier, and you cannot create a Cartier tomorrow. Even if you do the exact same designs, you will not be able to charge the same price as Cartier. But that is the key. If brand does not translate into better pricing power, then it's not worth anything. In the end, brand is a means to an end. The end being the ability to price higher than your competitor. Coca-Cola can sell you more expensive than the Sainsbury's brand or the Carrefour brand. That's the main benefit of the brand. If they cannot do that, and WeWork is a premium to Regis, to be fair, so they do charge a little bit more. But then, just to prove the point more, they charge more and still lose billions of dollars a year. Now they claim that some of the existing older locations that are supposedly mature are profitable, and time will tell. But just looking at the numbers, nobody has access to information. It's one of the worst prospectuses I've ever seen in my life in terms of disclosure. So we have no idea. I mean, even there's a beautiful J-curve chart there that supposedly tell you how their centers mature. There are no axes. There's no number that tells you years or dollar amount. That's how deceptive I think it's. I mean, I'm going on a legal limb here, but I think they're deliberately deceptive. I don't think it's an accident. And I don't think it's a trade secret. I think they're trying to lie. And that tells me something. And maybe I'll be proved wrong, but I think the odds are there's something that doesn't add up there. And maybe it's worth a premium to Regis, but is it worth 2 or 5 or 10 times? I highly doubt it. You had a couple, I think, that people sent before.
How is being a UNPR signatory changing the way you invest?
It doesn't. I mean, so a little bit of background here. So earlier in the year, we became a signatory to something called the Principles for Responsible Investment, PRI. So PRI started as an initiative by Kofi Annan and a lot of asset management firms a few years ago to create kind of a framework for responsible investing. And the United Nations supported that initiative and launched what became UNPRI. I came across it a couple of years ago. The main reason we didn't become a signatory earlier is we didn't want to pay the fee associated with membership. Couldn't afford it, basically. But we didn't change anything. I mean, a lot of what we've always done, since day one, we've talked about ethical investing as being a fundamental thing that we do. I've always talked about ethical being even a bigger circle than Sharia compliant, and I find that the two are one and the same. And when we applied for the UNPRI, they asked us to send them our process and how we incorporate those factors into the investment process, whether it is the industries that we're not allowed to invest in, for example, alcohol, tobacco, military, etc., or how we incorporate issues that have to do with governance and employee rights, how the relationship between employees and the company is, and all of these things that we do for both ethical and actually, I think, also business reasons. And we sent it to them, and we haven't changed anything. And they sent it back, and they said, "Perfect, we're already compliant. Go ahead and use the logo." So we had to pay the fee before we used the logo. But other than that, we haven't had to change anything. I think we've always been doing it all along. There is merit to becoming a signatory, so we became a signatory to this for two reasons. One is, in the past, you had to take my word for it. Now you know that someone is watching over us and kind of checking that we're doing things in a certain framework. And that matters a lot as the circle of investors expand. And the second thing is, I think part of what we do should be to expand the number of people who, kind of the supply and demand of this type of investing. I think everybody would be better off, the world would be better off if everyone became more thoughtful about how they made money. And I don't think, and evidence supports this. I've always believed that, and there's more and more evidence every day that supports this. It's not something where I have to sacrifice return to do these things. It doesn't seem to be, if anything, actually, the evidence that might be a net positive to returns when looked at over the long term.
How do you manage liquidity risk?
I think I know where this question comes from. The main issue, and some of you may have heard of this, it was definitely a bigger issue in the UK. So one of the largest UK fund managers and one of the most famous ones is called Woodford. And they recently had an issue with their fund where, well, actually until today, they had to suspend redemptions, even though it was a daily dealing fund with billions of pounds in assets. And they ran into, after a period of bad performance and a string of bad investments more recently that came in the news, there was a sudden demand for redemptions at the fund. And because they owned a lot of illiquid investments in addition to listed things, they also owned a lot of private investments. They had an issue with liquidity and had to suspend redemptions, and redemptions are still suspended, which is a big issue for the regulator and obviously for all the investors who came into the fund. There are two issues that we do, well, several, but two things mainly that we do that would protect us from that kind of scenario. Well, three actually. The first one, which is the most important one, is that we don't get ourselves into these types of investments. So we don't invest in unlisted securities. We only list by mandate legally. We cannot invest in in unlisted securities. So a big chunk of the issue with Woodford was that they owned private shares in private companies, and you can't sell those quickly. It takes time. The second thing that we do is and we're happy to share with anyone, we monitor our liquidity on a monthly basis and ensure that we can liquidate essentially all of the fund in less than our redemption cycle, which is monthly. And as we grow bigger, that can come down in terms of the cycle length, but that also prevents us from buying things that are too small or too illiquid, mainly because of that risk. So we want to make sure we're not in a position, we've always done this, this is not something new. We've always been in a position where sometimes we're going to lose on some opportunities if they're too illiquid for us, but we run an open-ended fund, and our responsibility is to the investors who stay. And because we cannot control who comes tomorrow and says, give me my money back, to protect the investors that do stay after that, we have to make sure that everything that we own is liquid and can be sold quickly in, not even have to do a situation like Woodford where there's a full liquidation, but even a big redemption cannot hurt the people who remain in the fund. So that's always been something that we manage for.
As you thought of last year we talked about the potential dividend that you want to make.
That's already an available option. So in any share class, whether you're A or B, there is an A2 and B2 share class. You can switch any amount from A1 to A2 or B1 to B2, and vice versa, depending on your needs. And if you are in the A2 or B2, the board will declare an annual dividend, and it will be distributed to your bank account. So that's already an option. It's been an option for a few months now.
What percentage?
So what we try to target is not a percentage of the amount that we receive in underlying. We're trying to target somewhere between 2 and 3% per annum as a distribution. And the reason we want to do is we want to manage the dividend across the cycle. So we don't want to pay a big dividend this year and a small dividend next year. We want it to be a smoother line, so we'll always try to manage it up or down depending on where we think things are. But that option is available, and you can easily switch between the two at any moment in time.
Any more questions from the floor?
Do you have any more?
I have one more.
Okay, let's take it, and I think
What's the difference between ESG and ethical?
and ethical. In theory, there shouldn't be a difference. In practice, I've always been of the view that people who, especially because now everybody wants to be ESG and it's the thing to be. I always feel that ESG is more of a, people do ticking a box, and I will not invest in this thing, or I will not invest in that thing. And I believe we need to go deeper than that. So it's not enough to say, those guys are in an industry that's acceptable, and that's ESG compliant, end of story. If management are bad people, or there's something uncomfortably fishy about what they do, even if it ticks the box, I still don't want to invest in it. I don't think that's ethical. And I mentioned earlier in the beginning, the ethical owner approach. I think anybody who's owned a business or been a partner in a business understands that even if your name is not literally on the door, your name is effectively on the door. So even if it's not called your last name, company, your name is there, and you're responsible for the actions of the company. And so even if it's in a permissible industry, or nothing they do is illegal, I think how they behave in general, I think the owners are morally responsible for that. And to me, that comes under, I think, the wider banner of ethical versus just a tick box approach, which I think a lot of ESG funds do.
The question, does your strategy managing the fund change with depends on the cycle, the economic cycle? I don't know if this is the question that's been asked or not, but we're expecting a lot of people talking about recession, economic recession. Will your position, do you find more difficult to find good companies, or everything is being expensive?
So on a very fundamental level, in terms of how we behave, how we kind of run our process, it doesn't change. I think the outcome changes, and it changes in two ways. One, you'll never find us holding 21% cash at the bottom of the cycle. I mean, there are just going to be a lot of opportunities and a lot of things to buy. So that's one thing that I suppose is different across the cycle. The other thing is, to some degree, where we are in the cycle, because of valuations, determines the conservatism of the assumptions that we put in when we make an investment. For example, at the bottom of the cycle, if Unilever is trading at 12 times earnings, you don't really need to think a lot about the 50 basis points or 100 basis point impact on organic sales growth numbers over the next 3 years. It doesn't matter. It's going to matter at the margin. At the top of the cycle, when valuations are high, you need to be more conservative about your assumptions, and you need to essentially do more work. So you can afford to be lazier when the market is cheap and you're at the bottom of the cycle, and you need to work a lot harder at the top of the cycle, both in monitoring existing investments and finding new ideas. Especially because at the top of the cycle, if something looks cheap, it probably is not. There's probably something you're missing. If the market is all expensive and something is trading at a low multiple, it's not cheap, you're probably missing something. Aubrey earlier in the video talked about hidden profitability. So I think, a lot of what we do is hidden profitability in a sense. And hidden profitability, I think, can be unlocked by a longer investment horizon. So a big chunk of what I think the source of our performance has to do with hidden profitability, which a longer horizon allows you to unlock. And the later you are in the cycle, the more you need to depend on finding investments with hidden profitability as opposed to stuff that's cheap because everything is cheap.
What is the longest time that you held on to a stock?
Sorry, can you say?
What is the longest time that you held on to a stock?
So some of our holdings can go down to very close to zero, or they fluctuate in size, and some of them will sell and come back and buy again at some point. That's one reason why answering that question is tricky. But let's do both. So LabCorp, I started buying in 2003. So we've owned it for the majority of the past 16 years, with probably 1 year and a half that we didn't own it. And there are a few times where it was a small position as opposed to a full position. And actually, looking back, the best thing I could have done is sit on my bottom and not buy and sell all this time. It would have been so much better if we just held the position for the past 17 years. Nordstrom we've owned off and on since 2006. I think there's only a year again that we didn't own it, but then it's been as big as a 7% position, and it's been as small as less than 1%. So sometimes if we like a business but valuation is expensive, we'll sell it down, and then before we fully exit, valuation comes down, and so we end up building it again. So that's why we may not have exited something before it becomes attractive again. And then of the things in the top 10 that we've owned, for 9 years at least since the inception of this fund, Alphabet we've owned since inception. Johnson & Johnson, which is also number 11 or 12, we've owned since inception. Again, different sizes. It was as big as 5, as small as 2. Now it's not here, but now it's 5 again. Henkel we've also owned since 2011, so we've owned it for a while. Microsoft, which is no longer in the top 10, it's probably way lower because we've been net sellers for the past 3 years. Again, purely on valuation. We still love the business, but purely on valuation. But Microsoft was something we also bought I think within the first month of the launch of the current fund. So there are a few there that we've owned for 9 years now. I mean, in most cases, the businesses that we like, the only reason we don't own them anymore is valuation. Because we find something else that's more attractive, or we think cash is more attractive than owning them. But there are a lot of things that we shouldn't have sold because the valuation kept going up. But there are a lot of things that we'll sell because at a certain valuation, we are value investors after all, and we have to keep valuation discipline, which is a cornerstone of what we do. And like I said, no FOMO, so you have to be willing to accept that. One more and then we should wrap up.
Okay, I know that your approach is mainly a long only value investing approach. That's what you're taking. However, for hedging purposes only, have you ever considered, and I think I asked that, have you ever considered shorting or getting into derivative products just for hedging purposes?
So hedging with using derivative products, we actually do that at the firm level. So we have a lot of sterling exposure at the firm. Our revenues are dollar-based, but we have a lot of liabilities in the UK, rent, payroll, all kinds of things that we are contractually liable for, and we hedge most of these using forwards. But that's a perfect example where you should, in order to manage business risk. We don't do it at the fund level. We are allowed to hedge currency in the fund, which we may do from time to time, but generally speaking, we don't do it with major currencies usually. Sorry?
Equities.
No, we don't hedge equities because the reason we don't hedge equities is it doesn't make financial sense over a 5 to 10 year investment horizon. It's just you're hedging for something that's not part of your strategy. If you have a 5-year holding period, why are you hedging for 3 months or 1 year? You're wasting money essentially given your mandate. If you had a different mandate, then yes, but for what we do, it's not. In terms of shorting, we don't do it in the fund. I personally believe shorting plays a very important role in the financial markets. The main reason we don't do it in the fund is that it doesn't fit my personality. I like to sleep better at night, and if there's something that I kind of have to worry about all the time because it might blow up in my face, I don't like to do that. All right, well, thank you all. I really appreciate you coming. Thank you for the great questions. Another great year, and inshallah we'll see you again next year. Thank you for everyone who's come from far away, and for people who sent questions via email. Some of them are actually in the room, but sometimes sending the questions earlier help us prepare for them. Then again, if you want to stump us on stage and kind of trick us into a quick answer, that's also okay as well. And Rand, I want to say
Thank you so much for being here. We look forward to seeing you next year, inshallah.
thank you. Please, we still have coffee, refreshments, and snacks outside. Thank you very much. Have a good evening.